Hello also to property and Propenomix people. So what am I going to be talking about in this video today? Well, I'll be kicking off as I usually do with Trumponomics and what the Donald has been up to over the past week or so. And then when I get into the deep dive, I'm going to be talking about 4 separate reports all about the housing market, the economy. It's been a big week in housing policy. So I'll also be going through the Bank of England Money and Credit Report for January, Zoopla's House Price Index for January 2026, and some figures from Scotland which tell us a fair bit about what's going on with landlord numbers and the number of rental units there are as well. So I'll be doing Commonhold and Leasehold reform, social and affordable housing, and then co-living in London, and also the build to rent numbers for the end of 2025. So they're quite impressive, but is the situation as impressive as it sounds? We'll find out. So if you've watched these before, you'll know I like to start with a quote, and this week's was £39 billion sounds like a colossal figure until you spread it over a decade. It feels like a pilot scheme dressed up as a revolution. That's from yours truly here on the most probably over-trumpeted achievement of a generation, benchmarked by a decade or more of actually absolutely choking the sector of any meaningful plan or contribution, realistically. So that talks about the deep dive and the social housing funding that's been talked about for about a year or so now, and what it's really going to do, and really what it's not going to do. So, but as the calendar advances through our golden quarter of the first quarter of 2026, our next property business workshop tickets are now selling. The tickets are live, and this one is about structure and exit, not only yours but also others. You've got no exit plan at the moment where you're going to go out one way or another. This was an extremely popular workshop last time. We sold out. I'm sure it'll be similar this time round. We're holding it in Manchester instead of London after popular demand for us to go to Manchester. So let's see who makes it onto the list. We've already sold nearly a dozen tickets, so it's looking like a really good one. And it's Wednesday the 22nd of April in central Manchester. So bit.ly/pbwten10 or tinyurl.com/pbwten if you want to use tinyurl instead. We'll be talking about pensions. We'll be talking about what it means for SASs, because obviously pensions have been brought into the scope of your personal estate for inheritance tax purposes. That certainly hurt some of my longer term estate planning. I don't know about anybody else listening, but this is from people who aren't selling you a pension solution. It's from people giving you an objective viewpoint and talking about how they use their own, aka myself and Rod Turner. So I hope to see you there. Now, Trumponomics is going to kick us off as we get into the meat this week, as we try and just catch those waves that the Prez seems to leave behind as he moves towards those midterms like a bull in a china shop. Quite a week as we were told that the UK's involvement and presence in reconnaissance missions in or around Greenland was labelled dangerous by the guy who can keep everyone safe, presumably, as long as you don't live in Minnesota, that is. Now, in one of the least surprising headlines ever, Trump didn't like Starmer's visit to Beijing in the past week, the first one for 8 years from a UK Prime Minister, and it was labelled very dangerous. He's not particularly creative, is he, on that front? The visit was broadly well received, though, internationally, as it was helping to thaw relations between the two nations and working towards a more sophisticated trade approach. I mean, the Donald can't really be surprised that making it more expensive and more difficult to trade with the US pushes nations to shop elsewhere, can he? I mean, he probably really should have seen that one coming. But I suppose he can, because he can do whatever he wants, and then generally he does, of course. But surely this is just rational behaviour from the UK, which is primarily being driven by the White House and its policy, and its specifically its tariffs policy. But there we go. The Lib Dems, alongside Chatham House Research, have been pushing for the UK to establish an anti-coercion instrument, as it's known, an ACI, to protect themselves from this era of economic bullying, as it is becoming known. I don't like what you say or what you do, so I move to tariffs, or I yank deals that were on the table or already agreed, theoretically. It's a pretty fair representation of what's been going on, to be honest. So what would an ACI do? Well, if coercion is found in a sudden trade move, for example, one you announced on a social media platform, ministers could immediately impose retaliatory tariffs. They could block foreign investment, or well, I'm not sure that would be a great idea, but there we go. Or they could exclude that country's companies from UK government contracts without needing lengthy parliamentary approval for each step. So the idea is to make the UK a bit more of a porcupine and make the bullies look elsewhere. Probably wouldn't work, but you can see the logic. I'm not sure Maybe Mr. Trump would respect a bit more strength rather than being obsequious and acceding to things too regularly, or at least saying it to his face and doing something else behind his back, which is the other thing that we've been doing, of course. Now, on that subject, I've said in presentations that I've given in the past that the NATO point, which the Donald has been making for a decade or more, which is, of course, that many countries have not paid their agreed fair share, their 2% of GDP towards defence. Of course, it is factually true, that point, but it also has an agenda, of course, which is buy some more defence stuff. Where are you going to get it from? Oh, the US make a lot of this stuff, so why don't you buy it from one of our American companies? Rather than spending your government's dollars on your tax dollars on things that the US is not benefiting from in the first place. So the solution to this realistically is to do no defence spending with US based companies and buy homegrown or European grown, realistically, of course. Now, announcing such a play and using those same tactics versus any other bully boy manoeuvres might be an idea, right? So tariff fatigue is now officially being recognised as a thing. That phrase is becoming more widespread. 33% of UK firms exposed to the US are already making strategic shifts or undertaking contingency planning, according to Chamber of Commerce data. Not sure what the other 67% will be playing at, frankly. But the feedback, like a lot of very subtle moves of capital away from investment in routes that point towards the US. And of course, this is the inevitable conclusion. I've said it all the way along. Ultimately, investment money does not like volatility. It does not like this extra risk. It might say one thing, or it might be too scared to say one thing above the line because Mr. Trump tends to be so vengeful apart from anything else. But ultimately, this is what money is going to do, right? It's going to flow away from the United States. No one's going to say it because they're all too worried of upsetting the overgrown child. Now, 21% of UK SMEs now rate US tariffs as their number one economic concern, above domestic recruitment or above tax considerations, for example. 21%, significant, right? Exposed small businesses are reporting an average 17% drop in sales and a 30% average rise in the cost of imported components when talking about what they've been doing with the US. So, I mean, look, it's seriously significant, that sort of thing, to a business, right? What are they ultimately going to do? They're going to look to develop markets elsewhere. Of course they are, because it's business, right? And volatility continues while Donald Trump throws this kitchen sink at impressing his voter base, and it will do so until the midterms swallow all of the attention. Oh, by the way, it's partial shutdown again as well. And this is what happens every so often when they need to raise the debt ceiling, this sort of fairly false process, really, that they have in the US. They've borrowed too much money. No one can be surprised. It was only a few months ago this was happening again. This is where they are, right? So they seem to enjoy these shutdowns, to be honest, because it helps them achieve a few of their objectives. So go figure. So now I've really compromised my chances of going to the USA at any point in the near future, once again, for daring to speak my mind. Let's get back to Chris Watkin and the relative calm of the UK real-time property market. Week 3's property stats show is now out. And remember, Chris talks Sunday to Sunday. So this was about the week ending the 18th of January. We managed even more listings than in 2025, once again, just about. So we're talking 96,541 versus 96,077. So it's close, about 500 more. But this is a huge glut over previous years, apart from 2025 and 2026. The sort of mega sell-off, or the mega attempted sell-off, basically continues. And it's been my theory throughout that ultimately the big difference has been that this is coming from ex-landlords. Doesn't mean they'll actually sell those properties, because if they can't get the price that they want, they may well rent them again, even though they don't really want to. It's a funny situation, but these people have got assets that they wouldn't buy today if they had another choice, and they'd love to get rid of them. But of course, from a rational perspective, they're also not going to give them away. It's also quite expensive to keep property empty, especially if you've been used to relying on some of the income from it, because ultimately you go from getting rent in, but not only just losing the rent, the council tax, the utilities and all the rest of it. So you do need to bear that in mind, right? But this glut of listings very much still looks on at the moment. We're following in from this world record Boxing Day that we had in terms of listings, according to Rightmove. Chris didn't actually do the numbers for all of that because he takes a hiatus over the holidays, and fair play to him, I say. The whole industry shuts down, so who can blame him? But we don't have Chris's take on what happened on Boxing Day. We do have Rightmove's, of course. So the lag of listings before the budget is most certainly over. If we left out 2025 and 2026, the average number of listings by this point in the year would be more like 72,500. So we're about 33% ahead of the 8-year average from before 2025. How about price reductions? Well, 20,000 plus price reductions, even though we've only hit week 3 of the year. So that's the biggest number of price reductions in week 3 for any of the last 10 years. So our trends from last year that took a little hiatus during the budget period and just before and after the budget seem to be continuing once again. But the whole market has pressed on. Don't worry, it's not just about listings, just not just about supply. 24,581 homes went sold subject to contract. So the week 3 average over the years is 23.4k. So a few percent ahead of the week 3 average in terms of what's selling. Plenty of demand out there, right? Net sales, well, they take 3rd place over the past decade, behind 2021, which won't surprise anybody, and also behind 2025. But remember, in 25, we still had that urgency and hope of beating the stamp duty deadline for deals that were agreed in the first half of January. And 2021, we know, started like an absolute rocket, apart from anything else. But to start January with there being a 10-year plus record number of homes on the market, which was 613,882, obviously down to that record Boxing Day, apart from the fact we started with quite a lot of stock anyway. 2025 had started with 605,088, so not a million miles ahead of that, 1.5% ahead of that sort of thing. But one more stat for you. Available rental properties in December 2025 in the UK, 285,000. That compared to 258,000 December 24 and 235,000 in December 23. So supply of rentals is increasing again, right? A longer time frame is needed to put all of that into context, yeah? But if new rents are flat or even down, which some people are telling me that they are in their portfolios, 10.5% more stock than the year before tells a bit of a story. Of course, it's all relative. In the old days, we had 350,000 homes available. So we're not up to the old days yet. And of course, we've got more people. But nonetheless, I'm talking about relative differences, right? I'm not talking about absolute differences. So, you know, Chris, I just want to say things just feel right when you share the data that you do with us. I want to just get my appreciation across to you. So thanks ever so much for what you do if you happen to listen to this. If you do want to get in touch with Chris, his channel at Christopher Watkin, well worth a look. Property Market Stats Show comes out weekly. There's lots of other content. He specialises in stuff for estate agents. But if you're looking for any kind of positioning to make yourself more of an authority in your local market, that's what he does in his day-to-day business. And I'd highly recommend him. He is a top banana. So what about when we get the macro scope out for the week? Well, we have the Bank of England Money and Credit Report, which is always full of rich data that we like to look at. We had a January Zoopla 2026 house price index, which also came out in the past week. And then we have another look north of Hadrian's Wall to see, look at this superior data that Scotland produces, mostly thanks to their landlord register, apart from anything else. So we can then have a best guess of what might be going on in England right now without us having the data, but more of a steer for the post-renters' rights implementation as well. And of course, we still need to talk about the gilts and swaps, so that will bring up the rear for us as always. So mortgage approvals took a surprising clip to 61,000, which is the lowest number since June 2024. Now, I know what you're thinking, though. December really should be quieter anyway. The years before weren't great yardsticks. December 22 was smack bang in the trust recovery phase or whatever. 2023 was repair after a woeful year in the property market. 2024 was falsely inflated by the stamp duty realignment. So we haven't really had any proper figures for probably 6 or 7 years for December. So it's difficult to say, but look, above 60,000 approvals is fine. 65,000 is the sort of steady market indicator that I've been using. And we've very much had a pretty flat line along that 65k for the whole of 2025. So a bit of a drop, but I'm not going to draw any conclusions from it because it is December. We obviously lose working days, but then also they get compressed into the early part of December. So nothing particularly to worry about, just something to note, I think, really, apart from anything else. So what I can say, though, is that 61,000 probably proves we didn't necessarily get the expected bounce that some of the commentators would saying would happen immediately after the budget in late November. I did say at the time I suspected people might wait for the new year because December is not particularly active in the property market, but still 61,000 mortgage approvals is still significant, right? Still plenty. So consumer credit also stayed pretty calm. The lid stayed on it, especially given that it was December. Not massive overextensions going on. I mean, there will be at the micro level, but I'm talking about the macro level, of course. Mortgage lending grew at 3.4% year on year, a number that's got sustainable written all over it. And the effective interest paid on newly drawn mortgages dropped to 4.15% on average versus 3.92 as the average cost of outstanding debt. As the great readjustment continues, we're nearly at convergence, or 23 basis points out anyway, and that gap closed just 7 basis points in December 2025. So we're very, very close to basically the cost of new money being the same cost as the outstanding stock of debt, right? And it's going to converge at around about the 4% mark, which isn't far off what people are getting charged these days for 4.1. The average, according to Rightmove anyway, have drawn down money, or the average product is about 4.25%. The average that's actually drawn down is 4.15. The Bank of England figures will be the correct figures. It tells you that more people than average, right, if that makes sense. So this year is that one, though, that's going to see the 2021 loans drop off, the 5-year fixes in 21. That's the last of the cheap money in any sort of volume. There will be, of course, clever people, perhaps smug people, who fix the 7 and 10 years in 2021, and well done if you did, but they will not be forming any part, not even 1%, I don't suppose, of the outstanding stock of debt by the time we get to the end of 2026. But the 26 debt, of course, is a significant amount cheaper than some of the late 2022 debt, the 2023 debt, a little bit cheaper than the 2024 debt and the 2025 debt. That's the way it's going, and that's my prediction is that we're going to carry on this year with it. And that's a little tweak downwards, but we're talking 0.1, 0.2. We're all happy with that because it saves us money on our mortgages. We'd rather it went down than it went up, but it's not going to pull up any trees, is overall my prediction. And the average term deposit, so when you've got money locked away in a building society bond style account or whatever, is earning 3.76%, or was in December 2025. And then the bank uses the term sight deposits, sight as in eyesight. It means they've got sight of them, you've got sight of them, you can draw them down at any stage, and they got a puny 1.75%. So nothing impressive there, by no means keeping up with inflation, however you measure it, let's face it. Now, what about loans? Because it's a good way to check on the health of the overall economy. Well, large businesses, the growth of loans there, 7.7%, and only 2.2% for SMEs. But SMEs spent years not borrowing money. And in fact, part of that could be because the bounce back loans and the C-bills loans have provided a lot of their requirements. They were, of course, cheaper money apart from anything else. But I think a lot of it has just been overall struggling with the impact of COVID. Apart from anything else, it hasn't been easy debt. It's now got a bit cheaper again, and firms can borrow in order to invest, in order to expand. But 7.7 for large, 2.2 for SMEs, a significant difference, of course. And the money supply grew 0.3%. I always keep an eye on that, a nice steady month. I was at a phenomenal presentation last week, and I was lucky enough to be invited to a fireside chat with a really preeminent economist and speaker who really translates the vagaries of the economy into actionable and understandable information with people. A former central banker himself, Roger Martin Fagg. Roger, it's always a pleasure talking with you. And he framed this really nicely when he talked about the money supply. Think about the money supply as the growth rate plus the inflation rate. So real GDP is obviously adjusted for inflation. If the money supply grows by 4.5, it's actually been 4.6%, the money supply growth December 24 to December 25. Well, there's room in there for 2% inflation and 2.5% growth. Hasn't shaken down like that, of course, because it's been more like 3.4% inflation and 1.2% growth. The numbers don't add up perfectly, but you'll notice they're very, very close. So really, within 10, 20 basis points. So that was me plugging in CPI and working backwards from there, as you can imagine. Now, what about this Zoopla or Home Track House Price Index then? 1.2% up year on year. That's their national headline number. A 9% drop in buyer demand. I wouldn't overanalyze this 9% drop in buyer demand for December because ultimately there wasn't that incentive to beat the stamp duty deadline by the 31st of March. So I would just leave that where it is, really, as a speculative number. They say 4% is the average mortgage rate for a 75% loan to value mortgage. Quite close to that reported 4.15. As I say, Rightmove said more like 4.25, but I think they just line them up and pick the middle one in Rightmove. Now, what did Richard Donnell, who is their Executive Director of Research, have to say? Well, he is a man always worth listening to. He said, buyer demand has picked up at the start of the year as confidence returns following budget uncertainty in late 2025. While market activity is improving, higher levels of supply mean pricing and presentation are more important than ever for sellers. And I would endorse what Richard said there. If you want to sell something at the moment, it's got to be well presented and keenly priced, realistically. Otherwise, it's going to struggle to sell. And Chris has provided us with figures before, Chris Watkin, on this side of things in terms of how much more difficult it is to sell a property if you don't sell it within the first 4 weeks. Really, really damaging. So go on at the right price and aggressively cut if you need to, if the market is telling you. If you're not getting the clicks, if they're not turning into viewings, if you're getting clicks that aren't turning into viewings, it's probably the price. It might be the particulars and the details. So obviously do scrutinise those very closely as well. But that's where we are. So Richard's report points out that confidence has returned in the market. There is a lot of stock, but plenty is being agreed, is exactly what the Watkin real-time segment of today's efforts supported. There's also an 8% spread between best performing and worst performing cities, from minus 2.6% to plus 5.5%. I'll let you guess where, just briefly anyway. Discipline is at front and centre for sellers, especially in southern England. So Zoopla's got the Northwest gaining 3.5% in 2025 and London losing 0.7%, with both the Southeast and the Southwest losing 0.1%. Worthing was the worthy loser at minus 2.6% in 2025 on the Zoopla numbers, and Burnley led the pack at 5.5%. Rochdale, Blackburn, Liverpool and Wigan all printed numbers above 4%, and despite there being plenty of stock at the nationwide level, homes for sale are actually down 7% in the Northwest year on year. That's an interesting stat, isn't it? London has got 14.2% more homes for sale than it had 12 months ago. So you can see the disparity. You can see why London's going to continue suffering, and London is suffering more than anywhere else but from this glut of stock there is on the market. And then Zoopla also reports 1.2 million transactions completed last year, smack on their prediction, I believe, or at least within their range of 1.15 to 1.2 million. I'd expect similar numbers this year. Zoopla cites the 20% more that a borrower can borrow compared to a year ago. But the choke on this market just seems to be the amount of stock there is around, alongside the enhanced moving costs that are out there because of higher stamp duty, apart from anything else. But to put that 20% into context, we really need to know how much money does the average person need to get into the average transaction compared to 1 year ago. But some great insight as usual from the Zoopla report. What about over to Scotland the brave then? Well, their landlords don't seem to be too brave. The headline from the Housing Register of Landlords in Scotland tells us we lost 4,807 landlords, which is 2% of the total, in Scotland in 2025. Now, sometimes this is just when they drop off the register because their registration is up for renewal. Some people will obviously be quite keen to get their details off the register if they're not landlords anymore, but we do need to bear in mind some people might have stopped, they've paid for 3 years or whatever, and they don't necessarily inform until they drop off. How many properties did we lose though? Well, only 213. So it's just clear evidence of consolidation in the marketplace. Fewer landlords and a tiny handful, a few less properties. Now, of course, if the population is going upwards and the rental want population is going upwards, even a flat level of supply is not particularly helpful, but there we go. Smaller landlords are selling to larger landlords. Personally, I'm stunned that they're paying the 8% additional LBTT, or the Land and Building Transaction Cost tax, as it's called up there. That's the Scottish stamp duty. But look, they must be. So there you go. Short but sweet and clear in its conclusions. So onto our gilts and swaps then. We opened at 3.94 and we closed at 3.961 on the 5-year yield for the week, last week. A tiny gain in terms of yield. We flirted over that psychological 4% barrier a number of times, but never really broke out past it for long enough. So we just went 2 basis points the wrong way from our perspective as borrowers. The 30s gained a fair bit more though. We went from 5.211 to 5.289, 7.8 basis points the wrong way. The yield curve got steeper. Ugh. The swaps also went the wrong way, with the 5-year closing Friday at 3.693%, and that discount from the gilt yield continues to be a fair bit narrower at just under 27 basis points versus the 35 or 36 basis points that we saw so often over the past 12 months. What's the translation? Well, 5.5% still looks like the cheapest rate for any new products in the limited company mortgage market if there's going to be no arrangement fees. So a week to forget really on the gilts and swaps. Moving on to the deep dive then, because it was a policy heavy week. Ground rents capped at 250 quid, zeroed after 40 years. Victory? Is it the right decision? Etc. Well, we'll find out. Then social housing progress with money available at 0.1% interest. Well, slightly one part of the jigsaw. Is it enough? There's also a major report on massive co-living developments in London, which I thought would be of interest because it hadn't really been on my radar before, and I'm not a London local. And we also get the chance to catch up on build to rent and numbers from the end of 2025. So the Commonhold and Leasehold Reform Bill. It's complex, over 500 pages of legislation and explanation. I've concentrated on the guide side, translating it in theory into a mere 83 pages the guide does. Well, this is just a summary, so don't worry. Our first theme is the end of the leasehold line and the new default. So what's the summary? Well, the government has explicitly positioned this bill, the draft bill, as the delivery of a manifesto commitment to dismantle the feudal leasehold system. The headline measure is a statutory ban on the granting of long residential leases for new flats. Once the new legal framework is operational, Commonhold will become the mandatory default tenure for all new flats. Exceptions to this ban will be limited to specific cases such as shared ownership leases or home finance plan leases, like Sharia compliant finance, for example. To enforce this, the bill proposes a rigorous regime where trading standards authorities can issue financial penalties of up to £30,000 per breach. Furthermore, consumers who were missold a leasehold flat in breach of the ban will have a statutory right to redress, allowing them to acquire the freehold Commonhold unit at no additional cost. The government is currently consulting on the precise timing and transitional arrangements to minimise disruption to housing supply. But I think we can fairly assume people aren't going to be selling new leaseholds unless they've been in a, I don't know how they're going to get a solicitor to participate, for example. And they'd have to be really quite hell-bent on doing things the wrong way if they were going to do that. What's the Propenomix perspective on all of this? Well, I've been talking about the death of leasehold for years, but usually with a bit of a pinch of salt, to be honest. But the draft bill suggests the government is finally looking to pull this plug. The language here is not subtle in any way. They're calling the current system exploitative and draconian. For developers, the message is clear. The model is changing, whether you like it or not. But my immediate concern is always in the transition period of these things. The government admits that common holders failed to take off since 2002, with fewer than 20 established in 2 decades. So, I mean, failed to take off is fairly soft, isn't it, realistically? But to jump from this standing start to a mandatory default is a massive structural shock to the system. They're promising to listen to industry regarding the timing, but if they force this through before lenders and conveyancers are truly comfortable with the common hold vehicle, we could see a significant air pocket in new build supply. This £30,000 fine per breach is a hefty stick to wave around, but the real killer for developers is the redress. If you sell a leasehold when you shouldn't, the buyer gets the freehold for free, and that's a level of risk that will force compliance faster than any fine is going to. Theme 2 from the report, the conversion crusade, this 50% threshold. So, a critical component of the bill is facilitating the conversion of existing leasehold blocks to Commonhold. Historically, this would have required 100% unanimity amongst leaseholders and lenders, which is a threshold that's in practice basically impossible, right? The bill slashes this requirement significantly, allowing conversion to proceed with the consent of just 50% of eligible leaseholders. So this is going to create a new category of resident, the non-consenting leaseholder, the NCL. If the 50% threshold is met, the conversion happens, and those who did not agree remain as leaseholders, but with significantly altered rights. Their leases will be amended to align with the new Commonhold Community Statement, the CCS, and crucially, NCLs will lose the statutory right to extend their lease. Instead, their only option to secure their tenure will be to buy the freehold of their unit, ergo converting into Commonhold. The bill also creates a mechanism to phase these leases out entirely over time. For instance, at the point of resale, the property must be sold as a Commonhold unit, no selling leasehold. I mean, this really is the most aggressive part of this legislation. Dropping the consent threshold from 100% to 50% is a game changer. It effectively allows a simple majority to drag a building into a new legal tenure. While the government frames this as helping leaseholders, the treatment of the dissenters, the NCLs, the non-consenting leaseholders, is severe, right? If you vote against conversion, you don't just get to stay where you were. You're stripped of your right to extend your lease. That's a huge blow to the long-term value of a leasehold asset. Don't know what your mortgage lender would think about that apart from anything else if you're an NCL. You're essentially being squeezed into Commonhold, eventually whether you sell or when your lease runs down. It creates a fascinating and probably litigious dynamic within blocks. You'll have half the building running the show as Commonhold members and the other half as NCLs who have voting rights on the budget, but technically answer to a unit owner who's likely normally the former freeholder who has been stripped of most of their powers. It does sound awfully messy, doesn't it? Sounds like a recipe for neighbour disputes that will make current service charge arguments look like a tea party. Theme number 3, the assault on income, ground rents and forfeiture. So, what's the summary? For the existing leaseholders who don't convert, the bill is also introducing sweeping financial reforms. Capping ground rents in existing leases at £250 a year, dropping to a peppercorn, basically zero, after 40 years. This measure does not require landlords to reimburse past payments, but it does cap future liabilities significantly. Simultaneously, the bill abolishes the right of forfeiture. So currently, landlords can terminate a lease for breaches of contract, potentially allowing them to take possession of the asset. This must be and will be replaced by a fairer lease enforcement scheme. Under the new system, landlords must apply to the court for a remedy, which could include an order for sale as a last resort, but ensures the leaseholder does not lose their equity over minor debts or infractions. The bill also targets estate rent charges on freehold estates, repealing the powers in the Law of Property Act 1925 that allowed rent charge owners to take possession of properties for unpaid charges. So what's the Propenomix perspective on this bit? Well, if you're holding a portfolio of ground rents, this is the news that you've been dreading. It's not as bad as what was said, as in no more ground rents ever, ever, ever. The 40 years is an interesting way of tapering it, but the £250 cap is effectively a blunt instrument. Whilst it spares the market of an immediate shock of a total wipeout to zero, which was mooted, the 40-year sunset clause puts a definitive expiration date on the asset class. Valuations will have to be adjusted downwards immediately to reflect this capped and eventually terminating income stream. The way this has been done is a fairly typical way this government approaches most things, right? They've tweaked, they've messed about with it a bit. It might be the best way to do this if you've decided that doing this is the way forward, right? And I'll talk a little bit more about the pain side of it in a short while, and who's taking that pain. So the abolition of forfeiture is equally significant for the mechanics of investment, right? Forfeiture was the nuclear deterrent that ensured service charges and ground rents were paid. Without it, freeholders and commonhold associations are reliant on the courts to enforce debts. While the bill introduces an order for sale capacity and capability, anyone who's dealt with the UK court knows this is going to be both slow and expensive. The shift of power here is palpable. It removes the leverage that kept cash flow steady for many blocks. You know, lenders are going to love the removal of forfeiture risk, but for those managing blocks, cash flow management potentially just got a lot harder. And what is the cost anyway? Well, 12.7 billion saving for the leaseholders is what we've been told. So from a mathematical identity perspective, that's costing someone 12.7 billion. Who is it costing that? The freeholders, ultimately. Now, this is a pretty dramatic improvement on the 30 billion that we were told when Michael Gove's time couldn't bridge this gap of this 30 billion that was going to be costed. It was mooted that the government was going to pay it apart from anything else. That's what under a blue government, that's what the lobbying was all about. What have the Labour government done instead? They've said, well, it's not going to be 30, it's going to be more like 13, but I reckon you're going to have to swallow it, folks, apart from anything else. So, you know, data's fairly weak on who actually owns all of the freeholds in the UK, right? So I actually went to AI and did a few prompts back and forth and said, you work it out, tell me how you've worked it out, tell me about your methodology, etc., etc. So what did that come back with? Private equity owns about 50% of ground rents, and pension funds have got about 15 to 20%. How did it get to that number? Well, it extrapolated how much M&G own and the sort of write down they've been talking about since the announcement. So ultimately, private capital and their returns are going to take the brunt of these proposals, or at least 50% of it. So there's going to be long and expensive court battles on the back of this, of course, and it's their duty to protect their own financial interests and the financial interests of their members. Of course it is. Loss to pensioners then, depending on how we look at it, probably 2.5 billion or so, which is also less than the loss that was created by Liz Truss and Kwasi Kwarteng in the mini meltdown budget of 2022 in just one day when the gilt market went into meltdown. Theme number 4, anyway, in the report, the reality of management, insolvency and control. So the bill is placing this community commonhold statement, this CCS, at the heart of building management. It's the rule book for all unit owners. Commonhold associations, or CAs, must legally agree on an annual budget through a member vote. If they can't agree a budget, the previous year's budget rolls over. So, to protect financial stability, the bill makes reserve funds mandatory and introduces powers to CAs to borrow money or in emergencies sell off parts of the common estate, like a car park for example, in order to raise funds. It also addresses the risk of CA insolvency, providing a process for a successor association to take over. Crucially, the bill allows for sections within a commonhold to separate costs and decision making in mixed-use developments, ensuring that commercial units and residential units do not have conflict over what are essentially irrelevant costs to one party or another. What's the Propenomix perspective? Well, this is where the rubber meets the road and where it might skid. The government is trying to make Commonhold robust enough for complex mixed-use sites by introducing sections, which is a sensible copy of the strata title system seen in Australia. But the reliance on members voting for budgets fills me with dread, quite frankly. We all know the apathy that plagues residential management companies, or RMCs. I don't know if you've ever sat on the board of one. I have, and it's certainly something I would never want to do again. Especially when you've got one particularly difficult member who just wants to do anything not to pay a penny more year on year on year. You know, really damage a whole estate by just having one difficult cog in a wheel. Now, this apathy now is going to have statutory teeth, right? If you can't get a budget voted through, you'll roll over last year's figures. Well, that's great when inflation's as high as it is, isn't it, realistically? That's a fast track to having a deficit. Then the CAs will be allowed to borrow and charge assets, which is flexible, but pretty dangerous in the hands of amateur directors, right? They're professionalising the structure, allowing professional directors to be appointed if no owners step up, but that costs money. The dream of taking back control often hits the hard reality that running a large building is a thankless, expensive and legally complex job. The bill creates the framework, but can't legislate for competence. What's it also doing? It's meaning that tons of people are going to do unpaid work here, and they're not going to be good at it. They're not going to be trained in it. It's going to be particularly problematic. There'll be a really difficult guide to follow on the government website. I can see it coming already. And this is the problem with this whole situation has been there isn't a necessary solution available. Right? There never has been a necessary solution particularly available. It's just going for a less worse kind of option. And we don't even know if this is less worse. I can tell you from experience of Commonhold in Scotland, it doesn't work well on low value units, and it doesn't work well on small blocks when you've got 6 people or fewer. People haven't got money around to do things aside from anything else. And if they have, they're looking to keep it in their pockets, not spending on the communal building. They don't care about the communal building unless their flat's the one on the top floor with the water pouring in because the roof is problematic, right? So, next up, we were due an update on this much prompted 39 billion for social and affordable housing that's been pledged over the next decade, and we got the update in this past week. Was it great news? So let's do a quick summary of the 39 billion supply stimulus and the low interest loans. So the government has confirmed the parameters for this flagship 10-year SAHP, it's called Social and Affordable Homes Programme. That's the side door really, squeezing the affordable in there because social costs so much more to build and run than affordable that it's really leaving room for a lot of interpretation. A lot of other places have generally dedicated social funds in order to make sure actual social housing is built. Haven't gone down that route in the UK, which will be marked out in there not being very many social housing units delivered, trust me. But over its lifetime, this programme is going to deliver 300,000 social and affordable homes. Once again, no qualified. It could be 30,000 social and 270,000 affordable. Apart from the fact that guess what, they won't even deliver the 300,000 for the 39 billion, right? But they've got a hard target of 60% designated for social rent. 180,000 social homes delivered. I can tell you now it won't happen with that sort of pot, right? But bidding for this new pot has opened in February 2026, and there are prospectuses for London and the rest of England that have already been published. Now, to complement this grant funding, the government is also introducing £2.5 billion low interest loan scheme available between 2026 and 2030, specifically for private registered providers, or FPRPs as they call them, for-profit registered providers. And these come with a highly favourable interest rate of just 0.1% over a 25-year duration. Unsecured loans, subordinated and designed to sit at the corporate level, intended to unlock additional homes over and above those delivered by grant funding alone. So pretty much free money. But of course, still, you take out a loan, you still need to pay back the capital. So do bear that in mind, of course. Still got to be able to be paid. Now, this is responding directly, apart from anything else, to the point that social yields somewhere between about 1 and 1.25% over its lifetime. That is all that it makes because the rents are so low and the running costs are comparatively high in terms of the percentage of the rent, right? But if you can borrow at 0.1 unsecured, then ultimately at 1.25%, you can still make a profit, which is why it's going to the FPRPs. So they're allowing a 1% margin there effectively, aren't they? Which is quite clever, and is going to be enough to get them moving on certain sites where they absolutely wouldn't have been moving before with a much higher cost of capital. So what's my perspective? 39 billion is this. It's a colossal figure until you spread it over a decade and then divide it by the construction reality of 2026 and beyond. We're talking 30,000 homes a year. It's better than a poke in the eye, but it's not the transformational supply shock the market desperately needs. Most research tends to converge on this at about 90,000 homes being needed. So the target is only a third of what's needed. And if we know one thing about this government and previous governments, in fairness, targets are not something that they meet on any form of regular basis at all, let's face it. But the real spice here is the debt piece, right? This 0.1% unsecured, subordinated, it's basically free money, yeah? It's a clever little lever that they've pulled, and they're using this more and more. I think the Treasury have tried to push the government in this direction in general, these sort of cheap or nearly interest-free loans. It's basically equity in all but name, but it's designed to shore up balance sheets that are currently groaning under the weight of remediation costs, yeah? But again, what's the problem? The pot's only 2.5 billion quid. Now look, let's not be too miserable. This could be a taster, it could be a toe in the water, right? But in the world of institutional capital, 2.5 billion quid is a rounding error, right? It's a pilot scheme dressed up as a revolution, and if they really want to move the needle, they'll need to add a zero to that fund, realistically. But for now, it's a nice sweetener for the for-profits, but it's not going to fix the systematic viability gap on its own. Okay, what about rent convergence and the 10-year settlement? Right, to provide the sector with long-term financial clarity, the government has already locked in this 10-year rent settlement, allowing social landlords to raise rents annually by CPI plus 1%. Crucially, the government has also confirmed the reintroduction of rent convergence to allow the disparity between actual rents and formula rents to be recovered. And this is a really important point that's been made by a lot of people over the sector over the years. Right, starting from the 1st of April 2027, landlords can increase rents on properties that are currently below the formula by an additional £1 per week over and above the standard CPI plus 1 limit. From April 2028, 1st of April 28, that cap rises to an additional £2 per week until the formula rent level is reached. So the government wants a gradual approach here. They want to protect the tenant to an extent, roughly 2/3 of whom are receiving housing support, but that means 1/3 of them are not. They're not on housing benefit, but they are in social housing. And they're rebuilding the financial capacity of providers to invest in new and existing stock. So what's my take on that one? Well, actually, finally, a bit of adult thinking in the room, realistically, because the sector's been screaming about rent convergence ever since the disastrous rent cuts of the mid-2010s and George Osborne's austerity plans just driving a truck through social housing, which hurt all the investment in it, George. It really was one of your most silly policies, although there are many to choose from. Let's face it, and let's never forget what a rubbish chancellor you were. But ultimately, this confirmed 10-year time horizon, this is the sort of time horizons you need for institutions. This is how they think, right? They think in 10-year time horizons and beyond. So it's really the bedrock that the CFOs, the chief financial officers of those organisations need in order to go to the bond markets with a straight face. It's basically a fix for a George Osborne ideological cock-up in the sector. But the convergence mechanism is a bit of a slow burner, waiting until 2027 and then 2028 for the pound and the £2. It's probably overly cautious given the immediate cash flow pressures, but it is a signal that the government understands you cannot regulate for higher standards without allowing the revenue to pay for it, and I'll be talking about that shortly. It acknowledges that artificially suppressing rents below formula was just a false economy that starved the beast. It won't fix balance sheets overnight, but it does help to stop the bleeding, right? It allows valuations to creep back up, which in turn unlocks borrowing capacity. It's boring, technical, and absolutely vital. So what about the Section 106 emergency rescue? So the government has identified in this report a critical failure in the Section 106 market, and well done. It was fairly obvious that all these homes sitting there without people to buy them, without HAs, without registered providers being in a position to be able to buy them and make use of them. And they've noted that the negotiation process has become synonymous with inefficiency and delay, and that uncontracted units are stalling developments. So they've released this emergency time-limited approach for uncontracted Section 106 units, where developers can prove that no registered provider is willing to purchase them. So this roadmap includes a requirement for all such homes to be registered on Home England's clearing service to gauge the scale of the problem. Furthermore, up to 10% of the new £2.5 billion low-interest loan scheme will be specifically allocated to support the acquisition of Section 106 homes, £250 million. The government is also exploring a greater role in crowding in private investment to clear this backlog and to prevent the development pipeline from contracting sharply. So this is the most alarming part of the debate and also the most telling. Because when the government is going to use words like emergency measures for Section 106, they are admitting that a primary engine of affordable housing delivery has effectively seized up. What's the reality? Well, RPs have stopped buying Section 106 units because they're too busy spending their cash on fixing damp, mould and cladding on their existing stock. Developers are left holding affordable units they can't sell, which means they cannot trigger the next phase of their private build. It constipates the entire housing delivery system. And this clearing service sounds like a polite way of creating a distressed asset register. And allocating this 250 million quid to it, of this 2.5 billion fund, once again, it's a drop in the ocean. If RPs aren't going to buy these units, we might see a forced 10-year flip, or we might see a massive entry of for-profit providers picking up these assets at a further discount. So if you're a developer sitting on uncontracted 106 stock, the message is clear. The cavalry isn't coming with a big checkbook, just a small loan and a new database. But clearing is the right word and the one to concentrate on. And the last theme from this report that I've pulled out is the heavy hand of regulation. So DHS and Energy, the Decent Home Standard. So what's the summary? Well, the government has confirmed this new Decent Home Standard will apply to both social and private tenures from 2035. The updated standard prioritises safety, decency and warmth, with specific requirements such as child-resistant window restrictors and strict timelines for damp and mould remediation under AWAB's law. Now, on energy efficiency, the minimum energy efficiency standards, or the MEES, have been finalised. Social homes must reach EPC Band C against one metric by the 1st of April 2030 and against the second metric by the 1st of April 2039. So similarly, the EPCs will be able to be extended. For whatever reason, they're 6 months ahead of the private sector on those deadlines, but there we go. The spend exemption cap of £10,000 has also been set for the social sector. The government has decided against mandatory floor coverings or enhanced security regulations to balance cost implications with supply ambitions. So just to explain to those of you who might not understand why we're talking about floor coverings, social housing is famously provided without floor coverings. So what you're essentially saying is you're moving poor people, because that's essentially who you're trying to house here, into a flat, people who can't afford lots of moving costs and all the rest of it, into a place with no flooring, which seems ridiculous. And this gap is actually covered. There are a few charities that actually work in this specific sector because they feel so sorry for people moving in without floor coverings in a place. But what's the problem? Well, the problem is ultimately it's not an energy efficiency measure, so it's not going to help with EPCs, and making it even more expensive for developers in this sector. The developers have just said, look, no, there's no way you can do this. It's going to make it even more difficult to provide supply. So they've left that bit out. Might seem a shame, might seem a bit heartless or whatever, but that's where it is, right? So my perspective on this, well, this is the regulatory ratchet turning again, right? The headline isn't just these standards themselves, it's the inclusion of the PRS, the private rental sector, in the new Decent Home Standards from 2035. That is a long lead time, right? But it signals the direction of travel, a unified standard for all rental property. And then for social landlords, the spend exemption of £10,000 for energy upgrades is the key number, right? It puts a ceiling on the liability for the worst performing stock, which is a mercy. But the operational weight of this is immense, right? Thermal comfort and reasonable state of repair are subjective terms that ultimately are going to keep the lawyers busy and lead to a ton of litigation over the years. This blinking on floor coverings, you know, they have obviously realised it's just going to kill the sector stone dead. It's a really grim trade-off. It is admitting those tenants are too poor to buy their carpets, but also admitting the landlords are too broke to provide them. And that just sums up the state of the market perfectly. High standards, low cash, desperate scramble to keep the lights on. But overall, this is progress, right? Especially on the cheap loan front. It's been said for some time the numbers don't stack up, and this is at least an attempt towards trying to fix that and to use the private sector to do so. And that overall is the only call, whether those with a political interest feel that that's ideologically right or not. Next up, we've got this Litchfield's report on co-living. And the teasers from this report, 26 major co-living applications have been submitted in 2025, totaling over 10,000 co-living homes. And schemes vary in size from about 100 to over 800 units. Those really caught my eye. So the first theme, the mainstream pivot from niche to master plan. Okay, the data suggests 2025 was a watershed year for the co-living sector, marking its transition from a fringe asset class to a central pillar of London's housing supply. According to Litchfield's, 26 major co-living applications were submitted just in 2025 alone, representing a pipeline of over 10,000 new homes. So what's the speed of this acceleration? More than 40% of the total number of co-living applications submitted in London since 2018 have landed on the desks of planners in just the past 18 months. So a significant chunk, right? So crucially, the scale of these developments is evolving. While schemes still vary from roughly 100 to over 800 units, co-living is now being explicitly written into the master plans of London's most significant regeneration projects. Major developments such as Earls Court and Barking Riverside now feature dedicated co-living elements, with Earls Court alone allocating 1,000 units to the tenure. This integration signals that the sector is no longer viewed as an isolated product, but a necessary component of mixed tenure delivery. Now, what's my perspective? We really need to be honest about this coming of age, right? It isn't some sudden cultural shift where everybody just woke up and decided they want to live in 21 square metre studios. It's a reaction to the absolute paralysis in the conventional market. The report notes that conventional housing starts in London sat at a pitiful 5% of housing targets for the first 9 months of 2025. That's not a slowdown, right? That's a cardiac arrest, okay? Developers are not pivoting to co-living just because they love the community vibe. They're doing it because the numbers for traditional build to rent and build to sell are currently strangled by viability gaps, construction costs, and the cost of debt. Co-living offers a density play that conventional housing cannot match. When you can squeeze 1,000 units into a footprint that might typically take 400 flats, the land value calculation looks very different. The inclusion of co-living in Earls Court is the real headline here. When the big boys of regeneration start baking this asset class into their master plans, it stops being a speculative punt and it becomes an institutional staple. It's a hedge against the stagnant sales market, a cash flow heavy asset that keeps the site active while they wait for the conventional sales market to find its floor. I've spoken for years how minimum space standards are, as they're set, a luxury that we can't afford. And in the way that market works, because there isn't an official way around that, the water finds a way to run downhill and get to the result somehow, within the rules, changing definitions and offerings. So, what about geographic and regulatory sprawl covered in this report? Well, the footprint of co-living is expanding significantly beyond its initial strongholds. Lichfield's reports that over 75% of London's local authorities have now received a co-living application, a sharp rise from just 50% in the middle of 2024. So, while inner London still accounts for a slight majority of recent applications, 55%, the split between inner and outer is becoming increasingly balanced. And as the geography widens, the planning environment is becoming more sophisticated, particularly regarding affordable housing. Historically, co-living schemes relied heavily on cash in lieu payments to satisfy affordable housing policies. However, there's a distinct shift towards on-site provision. Of the applications submitted since July 2024, that committed to an affordable housing approach, nearly 9 out of 20 proposed on-site delivery, typically in the form of conventional C3 affordable homes. This contrasts with the 40% of schemes that opted for a cash payment. So what's the Propenomix perspective? Well, I've always said that planning policy is a lagging indicator, but in this case, the boroughs are catching up fast. The fact that 3/4 of London councils are now processing these applications tells me that the fear of the unknown is dissipating. Planners are no longer looking at these schemes like they're alien spaceships landing in Zone 4. The shift to on-site affordable housing is the critical mechanic to watch here, right? For years, developers loved co-living because the sui generis classification allowed them to write a cheque for affordable housing rather than actually building it on site, which simplified management and floor plans. Now the councils are getting wise to this and demanding actual units. So this is a fascinating management headache and opportunity. You're now looking at hybrid assets, right? High density co-living blocks sitting on top of or next to a standard C3 affordable housing block. It complicates the exit because who's going to buy this mixed bag? But it smooths the planning process. So if offering on-site affordable units is the tax you have to pay to unlock the density of the co-living element, most developers will begrudgingly pay it. It's a trade-off, higher operational complexity for planning certainty. What about product metrics, viability versus livability? So as this sector matures, the physical product is finding a standardised equilibrium. The average co-living unit size has crept up to 21 square metres. Some schemes are offering a mix of sizes ranging from 18 up to the policy maximum of 27 square metres. And this slight increase aims to cater to different market segments within a single building. Conversely, the proximity of amenity space is tightening. The average internal communal space has dropped down from 3.5 square metres per unit, down to 3.5, from 5.5 square metres in previous years. So this reduction aligns with the adopted London Plan guidance, which introduced a tiered approach and encouraged flexibility. The focus has shifted from a blanket quantitative standard, e.g. 5 square metres, 5.5 square metres a person, to qualitatively good design outcomes, allowing developers to provide less space, providing it is high quality and well configured. Now, my perspective here, I've been shouting about this for years when it comes to minimum space standards. There are some fantastic micro flats around the world that we could draw inspiration from, and this whole logic in terms of compromising in terms of space standards here, this space in communal area we're talking about specifically, but this should be applied across the board in planning, right? If you've got well designed stuff, you don't need the 37.5 square meters, you can do with 30 square meters. What does that mean? You're basically going to get an extra unit for every 4 units you would have built before. A huge increase in density, right? Incredibly important, because you've got to do this to be viable. It's not about developers making as much profit as they can. They're not building this stuff at the moment because they can't make any profit at all, right? And it's only because the schemes that were ongoing have got far enough down the track, they're finishing some of those off. So this does need to be looked after if you want this market to work, right? It's a bit of a value engineering phase of a mature asset class. In the early days, the developers wanged in cinemas and bowling alleys and massive lounges to prove the concept and justify the rent. But now they've got data on what the residents actually use and ultimately want to pay for in their higher rents for build-to-renters. So you don't need 5.5 square metres of empty lounge space per person if everyone's just sitting in their rooms on TikTok or working in a single co-working hub, right? Reducing this amenity requirement to 3.5 square metres is a massive viability win. 2 square metres per person of wasted space from the developer perspective, and if they're not using it, from the user perspective, from the tenant perspective as well, right? Non-revenue generating space that can be removed to lower construction costs or converted into lettable areas. However, this increase in unit size to 21 square metres is the counterbalance, right? You're not going to squeeze people into 16 square metre boxes and take out their breakout space without risking a revolt or, more accurately, a void, apart from anything else. So this move to this tiered amenity approach shows that the GLA is finally applying some common sense, moving away from these rigid spreadsheets, I'm saying these must be this size or whatever, and looking at buildings actually and how they function. So it suggests there has been some quite good communication between the developers and the GLA, which I'm buoyed to hear about, although I'm implying that I'm taking that from what we're seeing rather than hearing that at first hand, of course. But it does allow developers to build leaner buildings, and given the current cost of debt, it's the only way a lot of these schemes are going to stack up. So it's a positive move and an inevitable market reaction to aggressive inflation, increased viability issues, and all in the face of continued demand to move to London. And then last up this week, the British Property Federation's report prepared by Savills on build to rent and what happened in the final quarter of 2025, because the numbers thrown around on the surface and some of the headlines recently have looked really positive about the amount of build to rent units that have been delivered. But is that the whole story? I suspect you might know the answer to that. So first theme really is this delivery lag. The average build to rent project taking 7 years from concept to completion. Feasting today and fasting tomorrow, I'm afraid, is the summary headline, because the report itself identifies that the figures from here paint a clear picture of a sector that appears on first glance to be booming, but then the total number of completed build-to-rent units has surged past the 146,700 mark, a 13% growth in completed stock over the past 12 months, but then this delivery drive was particularly strong in the first half of 2025. But this abundance of ribbon cutting masks a concerning underlying trend. The sector is emptying its pipeline faster than it can refill it. For 8 consecutive quarters, annual completions have outpaced starts, and consequently the number of homes actually under construction has contracted sharply, falling by 15% compared to Q4 2024. In the last 12 months alone, total starts plummeted by 45% to just 8,676 units, a figure that is half the average volume seen between 2017 and 2019. What's my perspective here? Well, it's the lag effect playing out in real time, isn't it? We're currently celebrating these schemes being completed that were funded and contracted when debt was cheap and construction costs weren't stratospheric. The 13% jump in completions is excellent news for tenants who are moving in today, but for the market in 2027 and 2028, it's just a disaster in slow motion. When you see starts down 50% from their pre-pandemic average, you look at a massive supply air pocket hitting the market in about 24 months or so. The viability equations simply haven't stacked up for developers recently, and with gilt yields where they have been, and SONIA swap rates stubbornly refusing to plummet, as I've been talking about, the cost of debt has strangled new projects in the crib. The data tells us we're eating our seed corn, we're delivering stock, but we're not replacing it, right? If you think the rental supply crisis is bad now, just wait till this collapse in starts filters through into the lettings market. And then the capital's construction collapse. Well, the summary, the slowdown in construction is a national phenomenon, but the data reveals a stark geographical divide, and London has borne the brunt of the contraction. The number of units under construction in the capital has dropped by a staggering 32% year on year, falling to 12,802 homes. In contrast, the region saw a much milder contraction of 7%. The figures for new starts in London are even more alarming. Throughout the entirety of 2025, there were only 613 starts in London, an 80% collapse compared to 3,105 starts recorded in 2024. So that will be whole sites, remember, that's not individual units, but still an 80% drop in terms of starts. While the regional markets also slowed, recording 8,063 starts, which is a 37% decline, the activity outside the M25 is completely dwarfing the capital at the moment. So, just let that 613 starts sink in London, a global city, population pushing 9 million people, barely 600 institutional rental homes within a year. Right, it's not a slowdown, it's a cessation of vital signs. And this is what happens when you combine aggressive viability challenges with a political environment that often feels hostile to development. The London premium has become a London penalty. Construction costs in the capital are eye-watering, and when you layer on the planning friction, investors are simply voting with their wallets and heading north. The regions are still seeing some activity, largely because the yield on cost actually makes sense in places like Manchester or Leeds compared to the razor-thin margins in Zone 2. If we were holding London residential assets right now, I would be looking at these supply figures and rubbing my hands. With practically zero new stock entering the pipeline, rental values in London have got no trajectory but upwards. Now, planning optimism versus application reality. So the report talks about a glimmer of hope really within the planning data, although it does come with caveats. The number of homes with detailed planning permission has risen to 67,307, a 17% increase compared to the fourth quarter of 2024, theoretically boosting the potential for future starts. But the top of the funnel is narrowing significantly. The number of new detailed applications submitted has fallen by 21% quarter on quarter, and total applications over the year are down by 36%. While the total pipeline, including completions, construction and planning, stands at nearly 299,000 homes, the flow of new schemes entering the system is clearly being throttled. So do beware, this is my take on this, right? This detailed permission metric, because it's the fool's gold of property statistics. A consent is not a building, right? It's a piece of paper that increases the value of the land. In a market where exit yields have softened, many of those 67,000 consented units are sitting on a spreadsheet rather than turning into bricks and mortar. They're oven ready in a kitchen where no one can afford to turn the gas on. Let's not forget those nearly 300,000 units permitted but not yet built just in London, as Molly All reported on late last year. The more telling stat is this 36% drop in applications. This shows that developers aren't even bothering to roll the dice on planning right now. The risk capital required to get a scheme to the application stage is expensive, confidence is low, and we're seeing a wait and see approach, which is ossifying into a do nothing strategy. Unless we see a material shift in the planning environment or the cost of capital, that pipeline is going to run dry very quickly. Then theme 4, the single family silver lining. Well, amidst the gloom of falling starts, the composition of the sector is slowly shifting. While multifamily apartments still dominate with 87% of the pipeline, single-family housing now accounts for 13% of the sector, totaling over 39,000 units. This BPF report notes that single-family homes continues to expand into new markets across the UK. This subsector is less reliant on the high-density, capital-intensive city centre towers that are currently the ones struggling for viability due to the 18-metre rule, high-risk buildings and all the rest of it, Fire Safety Act, Building Safety Act, etc. The data suggests that while the overall pie is growing slowly, the slice allocated to suburban housing models is becoming increasingly significant in the broader mix. So what's my take on all of this? Well, it's the smartest play on the board right now, right? The institutional move into suburban housing is only part of this report. It's the only bit that feels like it's got some genuine momentum rather than just inertia. It gets around the cladding scandals, it gets around the fire safety retrofit nightmares, it gets around these complex engineering costs of 40-storey towers. You can build a row of houses in the Midlands cheaper and with less planning grief than a block of flats in Bermondsey. Plus, the demographic, families looking for stability and willing to stay for 3 or 4 years, is exactly this sort of sticky income that the pension funds crave. The 13% share is just the start. As the London apartment market remains paralysed by costs, expect single-family homes to eat a much larger chunk of the investment allocation in 2026. It's a defensive play that actually makes aggressive sense. But you have to ask, right? Where are the yields at? I must confess I both understand and don't understand it. Let's do a quick breakdown. We should invest in property for total returns, although smoke-selling gurus tell us to focus on cash flow so we can sack the boss. The correct approach is no cash flow, no solvency, and no business, right? But how you grow your pot and what you do, what value you add versus the value of time and capital appreciation is all important. When you don't have enough, if you have a number that makes you want to stop, retire, or whatever, a mindset I don't really identify with because I don't think it's helpful. It implies you aren't enjoying what you're doing and only doing it for the money, in which case you're never going to be happy or satisfied anyway. You're constantly chasing market-beating returns. But when you do have enough or are allocating funds for other people, perhaps you're a fund manager, an investment manager, an institution, something like that, you've got a completely different problem. You don't want all the capital out of a deal necessarily because you're still going to need to deploy it again and again. You can be patient rather than always in a hurry. You accept lower returns, far lower, frankly, because you aren't hustling trying to build a smaller pot into a bigger one. You're trying to preserve a bigger pot for future generations. You're more concerned with return of investment than return on investment. And this is ultimately the difference between the BRR hustlers, of which I still consider myself to be one, absolutely, and the capital allocators. What does this mean and how does it translate to build to rent? Well, the developers and funds can accept lower returns that don't even work in today's debt environment for those of us who use leverage. How? Well, the expectation is that total returns do provide enough to make it worthwhile deploying the capital. Cash flow is needed if you do have a pension fund, for example, and residential property can provide inflation protection, cash flow, and safety and low volatility. So I might only get to a 3 or 4% return on the capital in the now, but with a 2.5% capital growth forecast, so that 6.5% might well be enough for me to invest. If I'm using a bit of leverage, then that 2.5% capital growth forecast can obviously be leveraged upwards as well. So bear that in mind. My cash flow is also growing though at 2.5% a year, let's say, if that's an average rent increase. And so the best comparison is actually to an index-linked bond, a bond that is attached to the rate of inflation, not a fixed coupon bond like the 30-year gilts, which we said earlier on, are trading around 5.25%, right? So if the index-linked bonds are returning a real 1% on top of the rate of inflation, it's roughly where they've been trading at for some time now. Things have reset themselves. And my build to rent returns, let's say, even 2.5% net after OPEX costs. I've still got a 1.5% premium over and above the linkers. On £1 billion, I probably don't need to tell you that's worth having. So nothing for us to get too excited about. We want our cash flow to cover our debt, cover our operational expenses, and provide us with a bit of margin as well. And really, we want our capital growth to be raw profit. That's how the culture of this business model has expanded since 2009 and the advent of the cheap money. And I say that because beforehand, especially in London, in a time of screaming capital growth, people were quite willing, speculators, to be involved in negative cash flow month on month in order to access that screaming capital growth. And the lenders allowed this, they facilitated it. And this was all brought to an end by the Mortgage Market Review, the Mortgage Market Directive, after credit had completely dried up anyway, following the Great Financial Crisis. But that's how build to rent works for some others, not just for us, to an extent. I'm not saying you can't convert buildings to hold for the long term. I've absolutely done that personally, but you need to understand there are very different metrics for capital allocators versus individual investors or those of us building a first generation property investment company. I hope that's some food for thought. So, my head's still buzzing after the amazing property business workshop last week in London. Tickets for the next one are now live. Finally, after much demand and many DMs, we are going where the action is at the moment, up to the northwest to Manchester. This workshop is in huge demand as we talk about exits, we talk about tax, we talk about risk, we talk about deal structuring, and we talk about exit options as well. Not just for you, but from those who you will inevitably be dealing with in order to buy assets, portfolios, companies, and the likes from. Can you help with their exit? I have over the years, often because they have no formal plan of their own. I've added massive value and it's helped to get deals over the line. Have you got children? Are you planning to leave a legacy? What does your plan look like? Do the kids know about it? They often don't, and spoiler alert, they often don't want to play ball either. And as always, we'll also have real life case studies about our own experiences, and we close with our no holds barred Q&A. If you've got something individual to consider, get yourselves a VIP ticket, join us for dinner in a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. Our VIP dinner was absolutely incredible last week and got some superb feedback. The upgrade is well worth it. You can get your super early bird tickets now for Wednesday, the 22nd of April in central Manchester at tinyurl.com/PBWTEN. But above all, whatever you do, whether you come to the workshop or not, please remember to keep calm, always listen to the supplement and carry on. There's going to be opportunities abound this year and towards 2030 and beyond. We've got this landscape set for a surefire bull run. Capital growth looks set to remain slowish at the moment, although if you're in the right part of the UK, you will be well looked after by the combination of that plus inflation. The big bull run needs some runway first, although let's see what the FCA and the PRA do around easing lending requirements again. But let's make sure we have an amazing golden quarter together. It's going to be a case of here we go, in my opinion. Thanks for listening.